I looked at what's called 100 baggers, and I looked at all I could find. I found 21 of them over the last 20 years. So 100 baggers, $10,000 invested, turned into over $1 million, right? It went up 100 times your money. And I went and looked at every single one, what it looked like prior to going on that run, and see what kind of commonalities they had. And they were all diverse businesses, they all across different industries. And the only one commonality I could find between all of them is they all had ownership, insider ownership, above 5%.
We're back with another episode of Building Better Portfolios. Per usual, I am your co-host, Paisley Nardini, and I'm joined as always, or usually, some of us, like we've been doing some solo podcasts here and there, but we try to keep the band together. So Josh Flade is my co-host as always, and excited for today's conversation. We'll of course dive into this, but I just think that how investors think about their equity allocations and what really are the drivers of returns is something that will definitely come up in conversation today. And Haren Bhakta is joining us to speak about much of the research that he has done and ultimately has led to the launch of his own index and now his own ETF. So super excited to have Haren join us. And Haren and I have brushed shoulders at various CFA events here in Orange County. So thanks for joining us today, Haren.
Yeah, thank you for having me on. I'm excited. I've been a regular listener of your show, so I'm excited to be on.
I think then they say, like, what is it? Like frequent or regular listener, first time guest or first time caller, like on the radio shows. Yeah. I tried that on Bloomberg once. They didn't find it as funny as I did, or as I thought it was, but awesome.
Yeah, but I've been catching you on Bloomberg. That's fantastic. You're doing really good stuff.
Yeah, thank you. I appreciate that. We appreciate you being a longtime listener of the show as well. Let's just dive right in. Why don't you give us a little bit of your background? Because I think it is super interesting. And I think sometimes, and a lot of us will just kind of fall into jobs. You work at a company, this is your title, this is what you're doing, but you were very intentional. You went out and launched your own index and your own strategy, and now it's in an ETF. So this is something you're very passionate about. So maybe just share with us how you've navigated this path, and then we'll kind of dive into the specifics of OWN.
Sure. Well, I started my career at Merrill Lynch as a financial advisor, servicing high net worth individuals. Spent about 2 years there, transitioned to Morgan Stanley, where I spent about 5.5 years doing the same thing, building a book of business. And I largely did that myself. I wasn't part of a team, so I had to kind of go out and get clients on my own. So it was just a very unique experience. Most of the people I worked with were all part of teams. And in 2017, I left to start my own microcap fund. I had found a unique microcap stock that I acquired a large position in, that I thought I could inflict some change. So I left Morgan Stanley, started the fund. I ran what's called a proxy contest on this tiny microcap. Ended up joining the board, and long story short, we ended up selling it in 2023. And in 2024 is when I created the Inside Ownership Index, and ETF had launched now 2 weeks ago.
Super exciting. I would also say too, just given what you've shared with us, obviously a bit of an entrepreneurial spirit in there, which I always admire. So before we dive in, we always like to ask the question, like, what is something interesting or unique about yourself that most people in the industry might not know, just to help our listeners get a little idea of who you are?
Yeah, I play a lot of beach volleyball. So I've been playing, I played high school volleyball, but over the last 10 years, I've been playing at the beach like once a week. I was playing competitively for a little while. I mean, I wasn't good, but I was entering tournaments and stuff like that. But I haven't entered a tournament for a couple of years now. But I still play.
What beach do you play at?
Mostly Corona Del Mar.
Yeah, I've played there. When I worked at PIMCO, actually, we used to do like beach volleyball, like a kind of rec league, like with work people. Very SoCal of us.
Yeah.
It's a great workout, though. That's awesome.
It is a great workout. And you know what? Beach volleyball is one of the few sports that you can play in your 70s. it might be hard to move on the sand, but it's low impact on your joints. And so I see 70-year-olds playing beach volleyball all the time, and they've been playing for years, so they know where the ball's going. It's a great sport.
Haren, I've got to ask. So, being an activist investor, because this is like the type of experience almost nobody's going to have in their life. Like, what if you could go back in time and give yourself advice when you before you started down that path? Like, what would you tell
Yeah.
yourself? Like, what's like a big lesson that you learned from that experience?
Yeah, my lesson would be don't do it. Now, now, when you're fighting a company, and I was fighting someone who had lost 99% of capital for shareholders. So it wasn't hard to convince shareholders that I could be a better CEO. But I'm fighting with my own money, and they're fighting with virtually unlimited corporate capital. So it's just an uphill battle, and it was just so stressful. I lost a lot of sleep, and yeah, I just would not do that again. And it's getting more and more difficult. I think going to my index a little bit, I'm somewhat solving the problem. There's a big systemic problem going on with S&P 500 companies where ownership is now tied up with three shareholders, BlackRock, State Street, and Vanguard, who really don't vote anymore. So you get these mediocre to terrible CEOs get locked in, and there's no longer any mechanism to remove them.
Which is probably like one of the biggest lessons you learned.
So maybe, Haren, if we think about what was the problem that you were looking to solve for, and then we'll talk about the solution, which I think is probably what's more exciting for people. But before we go there, like just recap briefly, like what was the issue that you saw, and how does the kind of the inside ownership component of this come into play?
Yeah, well, uh, how I thought of the idea, I think addresses that. Is I was sitting at the Berkshire annual meeting, which I've been attending since 2017. I'm a huge Warren Buffett fan, and I bought a lot of Berkshire for myself and for my clients. And it's because I trusted in Warren Buffett. And in 2024, this was the first meeting that Charlie Munger was not there because he had passed away. So I'm actually sitting at the meeting kind of afraid, thinking to myself, what am I going to do with Berkshire Hathaway stock when Warren Buffett passes away? I just don't think as highly of the company without Warren Buffett, right? And at some point, someone asked Warren Buffett a question about like equal weighted S&P, what's better, and that's when it clicked to me. The S&P 500 will be buying more Berkshire Hathaway when Warren Buffett dies, and most people don't know that. They free float adjust, so they exclude his shares, and when he dies, those shares become free floating. And I thought to myself, this has to be the exact opposite. Who would want more Berkshire Hathaway without Warren Buffett? Who would want more Tesla without Elon Musk? Who would want more Meta without Mark Zuckerberg, right? These guys created the value in their companies, and surely they can't be as um, lucrative, or who wants to buy into that story absent those CEOs, right?
Yep.
So when I came from home from Omaha, I looked into this. I thought, well, what if we just weight the portfolio according to ownership? So I looked around. I went to every data provider. I went to Bloomberg, FactSet, Cap IQ. I went to all of them to find this ownership data. None of them really had it. They have direct ownership only. So, for example, Reed Hastings owns his shares in a trust, right? Indirect ownership. So these data providers didn't capture that. So I had to go manually through every proxy filing for S&P 500 constituents over 20 years. So I had to go through 20,000 different proxy filings manually. AI wasn't a thing in 2024. It wasn't reading documents as
Yep.
accurately as maybe today. So I'm the
Sounds
only
like a
one that's
fun weekend.
aggregated the data. Yeah. Well, no, it was not a weekend. It was 3 months. But
Yeah.
yeah, yeah. So that's what created the index is that fear of investing in these companies where you trust leadership and not having the same belief in these companies absent the leaders, right? So the S&P 500 treats these companies exactly the same. You have a very successful company run by very successful leaders. Now, overnight we could change out the people in the organization, and would it be the same company? And most people would say no, right? But the S&P 500 treats these companies exactly the same.
Do you have any examples of some of like the large mega cap companies where it's probably a large allocation, of course, in the S&P or the Russell 1, but based on your analysis, then like there isn't a substantial amount of inside ownership, which kind of brings it down on like the rungs for you? Like, what's a name that might surprise people to hear that?
Yeah, well, one of the best examples I use is IBM. So IBM in 1984, right? In 1984, it was the most dominant company, and even till to this day, it's the most dominant company to ever exist. When I say dominance, I mean by relative size. So IBM was 2.5 times larger than the next largest company in the world. So this would be like Nvidia being a $12 trillion company today, right? It was dominant. Everybody knew IBM, and a lot of people don't know, but it was Thomas Watson Sr. that founded IBM, but it was his son, Thomas Watson Jr., that actually took IBM public and ran the company as CEO until the 70s, and remained on the board until 1984. So this was peak IBM 1984, right? He's on the board. Fast forward just 8 years after his retirement, IBM is not even in the top 10. And today, IBM is not even in the top 25. So this is what happens when those responsible for the success of an organization leave. Most companies will decay, and innovation lags. Same thing happened at Intel. Intel in the 90s, it was run by Andy Grove, right? Had you invested $10,000 in Intel when Andy Grove became CEO in the 70s, would have turned in several million by the time he retired in 1998. Now, 1998 till today, Intel stock is virtually flat, 27 years of no growth, right? They had 90% market share of the PC microprocessor business. Almost every computer out there had an Intel chip in it. The moment Andy Grove retires, Intel just turns into another company.
Have you seen examples whereby you might have the founder or the namesake, retire, pass away, whatever, like reduce the responsibilities, they hand that torch over? I'm almost thinking about like Apple, right? With like Steve Jobs
Yeah.
to like, but where that's been successful, where like, okay, they take it on, they take the ownership component on, they continue to innovate and grow. And so like from your lens, then as you think about what you're trying to hone in on, is it as much about like the key man risk as it is about like that smooth transition and taking that ownership on and then like the next generation? Like, how do you think about that?
Yeah, Apple's a great example. So Apple has continued to do well despite Steve Jobs, right? What I've found is these super CEOs, I call them, are able to pick a successor CEO, but the successor CEO is not able to pick his or her successor. And I haven't found a case where on a third generation,
Got it.
so to say, where the company's culture and innovative nature could continue. So Apple, without Steve Jobs, has continued to do well. Tim Cook, and there's another guy on the board, Art Levinson, who's the chairman, who have significant ownership. So the ownership at Apple is there. They have what I call, my T-shirt here, skin in the game. And that's the point, is that you want your leadership to have skin in the game. You want them to feel the pain of mistakes. And there's so many examples I have where companies who don't have skin in the game don't feel the pain of failure, and they aim for certain things that a CEO with ownership would not do.
So then, Heron, with your index, is it very then like analytically driven from the perspective of like just kind of pure numbers around ownership, or also how do you think about? Is there an element that's like, or I don't even know how you'd measure this, but like culture, right? Like I think of like my experience working at Goldman, and Goldman as a firm has been around for a very long time and then went public. I think in the 90s, if I remember correctly, and then they have had successive CEOs, and the firm has continued to grow and the value creation for shareholders over that time has been successful. But I would almost
Hmm.
attribute that to this ridiculously strong culture that's been built over decades.
Absolutely.
Like
And Goldman has ownership.
and ownership for sure.
Yeah,
Absolutely.
yeah, and partnership structure that really creates that and interlocks that culture, right? Um, and you know, you basically that's what you want. You want where people are working on the problem have power to make decisions. And when you have these companies with low ownership, it becomes bureaucratic. And those working on the problem are not the ones making decisions, and it goes up layers where everything kind of gets sugar coated on its way up, and bad ideas start to look like good ideas. That's why Elon Musk, for example, who's super close to the problem. He's working directly with the engineers. um, he's laid out his patents for all the car manufacturers to use, right? And yet they still weren't able to create the electric car, and it's because the people at the top are not talking to the people actually working on the problems down below. And cultures like Goldman are able to keep that intact. One example I use in the investment management industry is BlackRock. So BlackRock is the biggest money manager in the world, right? And that was founded in our lifetime. And the CEO, the founder, is still part of the company, right? Larry Fink. So all of the competitive advantages these legacy companies had, and yet the largest money manager in the world was founded in our lifetime.
I was just going to say, too, something that's come up a lot in conversation, and I actually want to pivot here to talk about what this means as it relates to your strategy from a concentration perspective, because I think it's kind of interesting. You take a step back and you think over the last like several decades, like active management historically meant higher concentration. You'd have a stock picking model and you'd, maybe pick 10 to 25 different stocks, high conviction. And passive was always this like uber diversified solution. And like we've started to almost see that reverse in the sense that like passive has become very concentrated. And again, not to knock concentration if you have high conviction, but like how are you concentrating these names? And so from like your perspective, as you think about the strategy that you've constructed, like what goes in to like the methodology? How do you think about the actual rules behind your approach? Because it is index, which means it is more of a rules base. This isn't just Haren discretionarily choosing, these names individually.
Yeah, so it's a completely passive index. So there was a study done by a University of Arizona State professor who looked at all stocks over 100 years, all US stocks. And what he discovered was is only 4% of US stocks that produced all the net wealth creation. The other 96% matched US Treasuries, right? So indexes are very power law driven, right? The returns and wealth creation really come from a small number, and that's even magnified even more over the last like 10 years with the
Mhm.
Mag 7, right? So it's becoming even more and more power law driven. But what a lot of people, where academia got it kind of like half correct, is the power law is even more defined when it comes to leadership. So if you look at the average CEO, you know, they're they're probably underperforming treasuries, and you're looking at some of the super CEOs, they're outperforming the average CEO by an even wider margin than maybe some of the best companies relative to the average corporation. So by indexing to these leaders, you're getting more exposure and more concentration by leveraging or allocating proportionally to these leaders' wealth. So that's what it is. We're really investing proportionally to these leaders who have significant stakes in the companies they run. So the inside ownership index is not a good strategy if you want more diversification. You can go to the S&P 500 equal weight for
Yeah.
that. But if you want more exposure to the most innovative companies, this is a good strategy. And the best example I have actually is Intel and NVIDIA. So in July of 2020, Intel and NVIDIA were exactly the same company. They were $250 billion, identical weighting in the S&P, right, at 1%. If you were a value investor, you would have looked at Intel and thought, okay, well, it has 7 times the revenue, 7 times the profit of NVIDIA, a higher return on equity, a higher free cash flow yield. It looked like the better bet, right? But NVIDIA had something Intel didn't, right? It had a CEO with ownership that went to bed thinking about the company every day, uh, woke up thinking about it. He dreamt about it. And fast forward 6 years now, Intel has underperformed the S&P 500, and NVIDIA is up more than 2,000%. So it's created enormous wealth. So the inside ownership index um, had 2.5 times the exposure to NVIDIA. So that's what I mean by capturing more of the outliers, the outlier CEOs.
I love that example because
Yeah,
it leads with data, right? It's not just like, oh, what do you think about Intel? What do you think about NVIDIA from a business model? It's all the metrics that any analyst or PM would look at to make a decision on how much to allocate or whether or not to hold. Like all of those were like check, 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 check. And then
yeah.
this metric that you're looking at, and there's other factors, of course, that go into this, but just showing the power of that. So, like right now, and we're recording this in mid-June. Like, what are some of the largest holdings within the index?
So um, NVIDIA and Google or Alphabet are the largest positions, right? Because they're still founder led. So Google, the founders, Sergey Brin, since AI came out, he's been in the office every day. It kind of like lit a fuse in him, and he's been working on the company. So it's hard to say who these winners will be in AI, but I could almost I'm very positive that it's going to be a founder-led company, right? You have companies like Apple, for example, who have not invested any capital in AI. And I think a sign of who's going to win is those who are comfortable um, failing. So you look at Amazon, for example, they had numerous failures throughout the years, right? Failed projects. That's a form of tinkering. So trial and error, see what works and see what sticks. And then you end up with something like AWS, right? Jeff Bezos has created 2 world-class companies because he's willing to do trial and error. And you have companies like Apple who have really leveraged the iPhone and had created phenomenal returns. But when the world changes, who's going to be able to adapt? And that's what you capture when you index to the leaders rather than the corporations themselves.
So, Haren, is there a market cap weighting kind of to this index, and then is it all cap? You're willing to go down to small and mid cap companies, or is it only large cap?
Yeah, well, the first ETF that we launched is the S&P 500 reweighted. So the starting universe is the S&P 500. And what we do is take the top 100 from there based on the dollar value of ownership. And then the portfolio, the constituents are weighted by that dollar value of ownership. So it's ownership weighted. It's completely unique. No one had thought of weighting the portfolio according to ownership. I like to, perfect analogy I have is I call a hired CEO a zoo animal, right? A zoo animal gets fed every day, whether it successfully hunts or not. These hired CEOs get their base salary, quarterly bonus, very often a golden parachute, right? I call an owner operator CEO a wild lion, right? That wild lion is trained to survive. It's already survived in the wild. If it doesn't successfully hunt, it starves, and they feel the pain of mistakes. So there's a difference. NVIDIA had that wild lion while Intel didn't, and that was the difference in results.
So between Nvidia and Google or Alphabet, you mentioned those are some of the two of the more concentrated positions. Like, what types of weights are we talking about? Because I think a lot of people are thinking about like uber concentration, and so just like to give a people like an idea of what kind of numbers we're talking about, like what size position
Yeah,
are those?
so NVIDIA and Google or Alphabet are about 11% positions in the index. And then you have close to that in Amazon, Tesla, and I'm thankful that SpaceX hasn't come into the S&P 500. So if SpaceX were to join the S&P 500, it would clearly join the inside
Yeah.
ownership index. So I'm very thankful that the S&P is waiting a year. So we don't decide which securities make it, right? The S&P 500 really decides which 500 are there, and then the numbers kind of tell us which 100 we choose. So SpaceX would have definitely made it in, and it would have been in a concentrated position.
So maybe I
Yeah.
guess that's a good question then as follow up, because if Tesla is a large allocation, given Elon's leading that, and he has a lot of innovation, and he's not afraid to take risk, that's very evident. Would SpaceX not be an attractive addition to your guys' index? Like, what is your hesitation there? More just like the unprofitability, or what are your thoughts?
It's the valuation and the fact that these insiders are locked in currently, but that's about to change. So I don't know exactly when their lockup period ends, but when it ends, now you're going to get a flood of people, insiders taking that liquidity, right?
Yeah.
Now, I'll give you an example. So my uncle worked about 17 years at NVIDIA, and he came out pretty wealthy. He outperformed almost every single one of his coworkers. So it wasn't just lucky that he worked for NVIDIA. He also didn't sell while his coworkers sold. So SpaceX, the employees are incredibly lucky that SpaceX wasn't public. They were able to be locked in and participate in that wealth without the ability to really sell. But now that's going to change, right? That lockup period is going to open up for them, and they're going to be able to access the liquidity of the market, and they're going to do it in droves. So I'm happy that we get to let SpaceX settle down before it really joins the index. And I'm not bullish on SpaceX. I'm incredibly bullish on SpaceX as a company over the next 10, 20 years. But in the immediate future, you're going to get a massive number of employees access to capital markets to get that liquidity that they weren't able to before.
Do you have a limit on kind of what, like an artificial limit on the sizing of like your largest position?
Yeah, we have two kind of limits. So the first one is we cap ownership at 5%. So, for example, Larry Ellison owns 40% of Oracle, right? Well, we don't want a portfolio of two stocks with Michael Dell owning 40% of Dell. So we cap ownership at 5%. So any ownership beyond 5%, we don't count it. And there's a number of reasons for that, which I'll get into. But the other cap we place is for typical U.S. tax law for ETFs. So ETFs to have favorable tax law with not having capital gains in the ETF. You can't have any one position above 25%, and you can't have all the positions above 5% can't total more than 50%. So we just comply with that tax law. So for example, NASDAQ 100 is no longer, a lot of people don't know this, it's no longer market cap weighted. It's had to make adjustments because of the over concentration to comply with US tax law. So we comply with that. So simply not having over concentration in complying with tax law, basically. And then the first one I mentioned is capping the ownership at 5%. So I looked at what's called 100 baggers, and I looked at all I could find. I found 21 of them over the last 20 years. So 100 baggers, $10,000 invested, turned into over $1 million, right? It went up 100 times your money. And I went and looked at every single one, what it looked like prior to going on that run, and see what kind of commonalities they had. And they were all diverse businesses. They all across different industries. And the only one commonality I could find between all of them is they all had ownership, insider ownership above 5%. And there were two exceptions. So the two exceptions were Apple and FICO Isaac. This is between 2000 to 2025. So Apple and FICO Isaac were the only two exceptions to the rule. To get these massive outlier returns, there had to be ownership. And it wasn't necessarily founder run. It wasn't necessarily that the CEO had the ownership, but someone on the board or C-suite had significant ownership. And that's what it takes to maintain a culture. So when you're a CEO or board with no ownership, right, you're judged quarterly, and therefore you aim quarterly. But true value creation is people who think in decades. So, the best example I have is Amazon. Amazon didn't have a profit for two decades, right? Because Jeff Bezos didn't care about the next quarter's numbers. What he cared about is creating a decade-long value.
I love that. It goes back to your slogan, right? Of like skin in the game. And I think irrespective of your investment acumen, and if you're, accredited or, sophisticated, or you're just a normal person listening to this, it's like that resonates, right? And then, like, as you were talking earlier, I was thinking about like, it's really people that are willing to roll up their sleeves and take risks. And like, that goes back to, what honestly our country was founded on is capitalism and being willing to kind of build something. And I think that this strategy itself really resonates probably with a lot of people. So like, I want to then now kind of move our conversation into how have the investors that you've spoken to, how are they using this in their portfolio? Like, how are they complementing, replacing, diversifying existing equity exposure? And then I want to start to talk a little bit about like, what does it take to actually launch an ETF? Because I think that's something that a lot of people have probably had really interesting research or thoughts on. And all we hear is that it's super easy to launch an ETF now. So like, I'd love to hear like, how easy is it? What type of commitment? But maybe just start with like the first part of that question.
Yeah, well, I'm finding a lot of advisors using the strategy. So I'm partnered with a few financial advisors, and they're using it to actually reduce exposure to the stock market. So it's funny because I created what I think is a great strategy, but it gives them the ability to invest less so in the stock market because it's more concentrated. It's more concentrated to the things that are working now, right? So they're able to use other strategies outside of equities to diversify their client portfolio and still somewhat keep up with the stock market by allocating to the inside ownership, because you're essentially investing in those companies that happen to be working. And then addressing your ETF question. So, as you know, I went around looking for ETF issuers to launch this index, and I found the perfect partner in Corgi Funds. It's a new company, but they broke the record twice. They have launched more ETFs than any other issuer ever on two different occasions. I think they launched like 80 and 30 on another occasion. They've now have over 100 ETFs. They filed to launch over 300 ETFs. So they are just disrupting the entire space. They're going to have more ETFs than BlackRock. So they're leveraging AI in a big way to kind of cut out the middleman that's been involved in launching ETFs. They are bringing down the costs of so many different types of strategies. For example, levered ETFs have on average above like 1% in fees. You know, they've brought that down by half, I think. So they're really cutting costs and giving the end investor the benefits of those cost reductions. So I found a great partner that's aggressively launching ETFs. So for me, I created the index, and finding a partner to serve as the investment advisor and issuer, I think it's a perfect strategy for me where I could just kind of go out there and talk about the index and how it's constructed and its methodology, and really leave the investment advisor and compliance and all that stuff to another company.
The less fun stuff, as we like to call it.
Yes, yes, yes.
That's wonderful. So where can people find out more information? I know that like you have your index, and then the index was launched in the ETF. So there's probably a couple different places where people can find more info.
Yeah, well, I would encourage people to check out our website, insideownership.com. Very easy, insideownership.com. And yeah, they could find my email in there. They could reach out to me. I'm on all over social media. Very easy to find.
I love that. And then also people can reach out to Corgi Funds directly, and if they are looking for more information in that ETF, or you can connect them directly with that team as well.
I'd be more than happy if someone has a great ETF idea and wanting to launch it. Corgi is a great partner. They're very aggressive. They're coming out with some very niche strategies, extremely niche. I mean, we're talking about like coffee. Any company in the coffee industry, they have an ETF for it, or energy drinks, or just very niche ideas. They're willing to launch ETFs for it. So yeah, I'm happy to connect them. They can reach out to me, and yeah.
Wonderful.
As an asset allocator, I think that's exciting, because if you do develop a view on something, it's so nice to be able to find an ETF or something, some easy kind of plug and play solution to express that view. So I think this is
Exactly. So that's what they're creating, the
fantastic.
ability for people to express their view in any area in the market. And they've been very successful. They identified a market, I think the photonics for chips. And yeah, I think they got like 300 million in there within like a few months. So it's pretty
Wow.
crazy how
The
successful
rise
they've
of
been.
these thematic active type solutions. I mean, you think about it, like SMA, separately managed accounts, have been around for decades, and it just didn't allow then smaller allocators, asset owners to express these views because they just didn't have the scale to launch a separately managed account. And so, to your point, Josh, now that we have all these very thematic solutions in ETFs, it makes it way easier to customize and build more thoughtful portfolios based on your views and your objectives.
Yeah,
Yeah.
absolutely. Well, Heron, as we kind of get closer to the end of this, I'd be interested in, and by the way, like I'm very impressed with your career. I have a great admiration for people who are kind of like lone wolves, right? Which I don't know if that's how you would describe yourself, but I kind of get that sense, right? Like you don't normally go to Merrill Lynch or Morgan Stanley. Like you tip as a lone person, you typically find a team and join a team. So I think that's very impressive that you kind of built a book and you did it on your own. At the same time, though, I feel like even lone wolves probably have people that they learned from or people that inspired them. So is there anybody that you've worked with or a mentor, anybody that really had a material impact on you? And this is kind of your opportunity to kind of tell us about that, maybe give them a little shout out.
Yeah, well, this is gonna sound a little cheesy, but I've listened to every Berkshire annual meeting since 1994. They're on YouTube, and I've listened to them more than one time. I mean, I find it really. I go on hikes and listen to Berkshire annual meetings. So I've listened to over maybe like 5,000 hours of Warren Buffett. I feel like I could ask him a question and get an answer. So yeah, I've gotten no one has influenced me more than Warren and Charlie. So I have to give them a
I
shout
love
out.
that. Have you met
Yeah.
Warren Buffett in person at any of his meetings?
I've attended the Berkshire meeting. I've never asked him a question, but I've also attended a daily journal where Charlie Munger was the chairman and he would answer questions. So I was able to ask Charlie Munger a question. And yeah, that was great.
Yeah,
But I've
yeah.
never actually spoken to Warren Buffett before.
Well,
I've
I'm
written him
sure
letters.
if Warren Buffett's listening to this, which he probably is,
Yeah.
Haren would like to meet you. Make that happen.
Oh, I would. And I thought of my whole index while I'm sitting there at his meeting. So yeah.
That's
What
wonderful.
and what I love about that answer is that how cool is it that we live in a day and age with technology and knowledge sharing that you can find inspiration, like these people can touch your lives and without actually like meeting them in person, right? Like you just learn
Yes.
so much from them,
Yeah.
reading books and listening to them talk, and so that's fantastic.
Charlie Munger says that all the time. He says, there's no more important thing than choosing your role models, and role models don't have to be alive.
Well, thank
Well,
you,
Haren,
Haren. Yeah, I
yeah,
really
thank you.
appreciate this.
Yeah, thank you for having me on. It was fun.
Great. Well, thank you, and we'll look forward to watching your success.
Thank you. Thank you. All
Yeah, go
right.
crush it. Awesome. Thanks for
Yeah.
your time today. The views and opinions expressed on this podcast are those of the host and do not reflect the views, opinions, or policies of any current or former employer, affiliated firm, or client. The content is provided for informational and entertainment purposes only and should not be considered investment, legal, or tax advice. Nothing discussed constitutes a recommendation to buy or sell any securities or investment products. Listeners should conduct their own research or consult with a qualified professional before making any financial decisions. The hosts are speaking solely in their personal capacities, and the podcast is not affiliated with, sponsored by, or endorsed by any firm or organization with which they may be associated.